Hi, and welcome to another session of the Venture and Capital Interviews. My name is Steve Torso, and today I've got with me Daniel, who's the managing partner for Newground Capital Partners. Now, I've known Dan for at least about sort of 8 years, and I've watched him sort of grow and sort of evolve his business to working with investors from Australia and right throughout Asia. So firstly, welcome, Dan.
Thank you, Steve. Great to be here. Thanks for the invitation.
No problem. And so look, as a start, can you just give us a bit of a background as far as to Newground Capital Partners and also a bit of a background to yourself?
Sure. So Newground Capital Partners was established in 2015 and evolved out of, I suppose, its predecessor company, Newground Property, which we established in 2009. Newground Property was in the development advisory and development business. And it was around about 2014, 15, we were doing some developments of our own, and we realised that we were probably better off taking our IP and our capital and partnering with some of the best-in-class developers that we'd had acquired as clients up until that time, instead of trying to compete against them very badly. We were better off taking more of a private equity approach and taking that capital and that IP and enabling those best-in-class sponsors to do more projects, do more business. And so we started Newground Capital Partners as a dedicated funds management, investment management platform, got our wholesale AFSL, and set about building our track record in our business since that time.
So what sort of, so when you were starting out, what type of projects would you normally sort of look to fund, and what sort of key attributes were you looking for in different deals?
Well, at the time, 2015, 16, there was the residential apartment boom was right. It was right in the middle of that. So clearly, the vast majority of opportunities across the eastern seaboard and was in the residential space. However, we're sector agnostic as a provider of credit or provider of finance. We aren't necessarily having to take a forward-looking view as you would as an equity investor in a particular asset or sector. We're simply taking advantage of a structural change in the Australian finance or banking landscape, insofar as a reduction in the bank's appetites to fund construction and investment in real estate for a number of reasons, most notably the imposed changes by the federal regulator APRA and the cost of capital associated with carrying those types of exposures. And so for us, we're rather sector agnostic, and we'll invest in a range of sectors. In fact, the last two transactions we closed were neighbourhood retail centres. So the opportunity is really wherever the vacuum of credit or finance is, and that is across the sectors.
So with those last two transactions, what was the appeal with them?
What was the
appeal?
What was the appeal with them? Well, first and foremost, the sponsors in both of those instances were sponsors that we had on our list of people that we wanted to do business with. At the end of the day, whilst we're financing or providing credit, we're still effectively partnering with people. And whether you're investing in a early stage venture company or investing in a property project, you're still investing in people, and you want to be financing or investing in best of breed executives and best of breed management. And so the sponsors that brought these two particular opportunities to us were people that fit that criteria. Secondly, it was in a sector that I mentioned, neighbourhood retail, which we felt had very defensive characteristics, which was most recently tested during this COVID crisis, where ironically the neighbourhood retail centres were some of the only pieces of real estate that remained open, in some cases 24/7. Coles and Woolworths anchored centres, remained open. They didn't ask for rental abatement from their landlords. In fact, some of them actually hired more people, and I think they proved their essential status in the communities that they serve. So we were attracted to that, and the consultant team and the opportunity to build out a pipeline with those particular sponsors. So those were junior debt investments, so where we had introduced a senior lender in the form of one of the major banks, with Newground investing a secured junior debt tranche behind the major banks and in between the sponsors' equity. So both of those projects are currently under construction right now, and probably due for completion the back end of next year. And we're seeing continued evidence in the market of continued support for those assets, completed assets from the private and the syndicated market, seeking long-term defensive yield and paying some pretty attractive cap rates for those assets. So we remain.
I was going to say, and just on that, what is typically like for you, for your investors, like what are the yields you're typically sort of chasing for them?
Well, that is entirely dependent on the risk profile insofar as where we sit in the capital structure. So I think it's fair as a broad brush statement to say with senior debt transactions where we are effectively the bank and are providing a first mortgage transaction either to acquire a piece of land or construct a piece of land, the returns generally sit between 7 to 10% per annum, which when you consider today the risk-free rate being the 10-year Australian government bond in Australia is trading at about 80, 85 bips, and your 3-month bank bill swap rates trading at 10 basis points, an 800 basis point premium on the risk-free rates, and for a first mortgage position is a pretty attractive return for investors that are all seeking yield to fund retirement and so on. Mezzanine transactions tend to trade in that sort of 12 to 15%, 12 to 16% range, and then preferred equity, generally 16 plus up into the 20s. And there's a range of factors that affect those returns, but that's fairly indicative.
What I've been really impressed by you is number one, I mentioned sort of in the intro that you have been able to, you've done a lot of work with family offices both throughout Australia and also in Asia. When they sort of become a client of yours, what's their appetite? What are they typically seeking? What's the sort of reason they partner with you?
Well, if we talk about family office investors specifically, because you'll appreciate, Steve, that each segment of the investor universe is inherently different, has a different set of needs and challenges that they're faced with. The retail investors different to wholesale investors, different to family office investors, different to institutional investors. And with family office investors, if you've had any experience with them, you'll know they're extremely sophisticated. Most of them, there's a reason they have a few $100 million to invest in the first place, and it's usually by being very shrewd at what they do. Generally speaking, they're used to investing direct into opportunities, so they tend to prefer opportunities to co-invest side by side with a manager or into an opportunity as opposed to going through a fund. That's not to say they don't invest in funds, because they do, but their preference is generally direct, where they have more control or discernment over what investments are made. They are very responsive and very quick to make decisions, which is one of the attractions of dealing with them. If you are able to develop a relationship with the principal or the decision maker in the firm, you can usually get to a decision a lot faster than you would, say, an institutional investor, where there's certain layers of governance that mean the process will take significantly longer. So that is attractive. And like anything, if you build a relationship with these investors and partners, you can build a very long-term business relationship that you can count on to reinvest and to grow together. So
now you've obviously spent a lot of time in Asia. How have you found the difference as far as working with investors looking for, I suppose, returns in Australia as far as dealing with them in Asia? And how have you found the change of that over the last 6 to 12 months?
Yeah, it's a good question. I'd say, look, most investors are all the same insofar as, and that probably goes contrary to my earlier point, but we talk about family office investors from Asia, which our experience has typically been from Hong Kong and Singapore, and then family office investors, say, from Sydney, Melbourne, Brisbane, Perth, and so on. They share commonalities. They're sophisticated. They want control over their investments. They can move quickly and so on. I'd say some of the differences come around familiarity. Certainly, people from Melbourne are going to feel much more comfortable investing in a transaction in Toorak than, say, someone from Hong Kong if they're not familiar with that market. So there tends to be a bit of a delay or a slower in the process sometimes. I tend to find Singaporean investors tend to be a little bit more conservative than their Hong Kong counterparts. And that's, perhaps a cultural difference, or it may just be individual. But again, whether they're from Singapore, Hong Kong, or Melbourne, it comes down to that relationship. And if you spend the time, and I think this is a critical point, a lot of people I've found in my travels, certainly from Australia, that think that go overseas expecting, to find their riches, kind of believe perhaps naively that it's a case of showing up at the airport, doing a couple of meetings, and people are going to be throwing money at them just because they're from Australia. And, you laugh, but, there's people who genuinely believe that. And just like as you would be expected to build a relationship with someone from your own hometown, it happens over a period of time. And it may be 6, 12 to 24 months before you get to a point where that person feels that they know you well enough to trust your decision making and trust your character, such that they will bestow you with some of their family's capital. So patience is absolutely required.
Completely agree. And obviously you mentioned about COVID. You sort of, obviously we can't sort of have a conversation like this and sort of not mention it, because obviously you're in Brisbane, I'm in Sydney. You can see the changes that it's made to the CBD and the sort of local shops around here. What's your, you obviously get to speak to a lot of investment groups and a lot of people in the area. What's your thesis now as you sort of think about the next sort of 6 to 12 months, and where are you looking for opportunities?
Sure, good question. So clearly when it all kicked off, everyone was in panic mode and no one could see anything, and it was just a whole lot of irrationality. That's
because we're all going to die, mate. That's what everyone's worried about.
It's the end of the world. That's right. Where am I going to get my toilet paper from?
Yes.
So that's thankfully subsided, and there's a sense of calmness and rational thought that's in most of the investors' minds that I speak to now. However, what I've seen is there's been a polarization in attitude, I think, towards risk and appetite for risk, insofar as there's a segment of our investor base and those that we speak to that have now moved even further down the risk profile and said, volatility I just can't deal with. Capital preservation is absolute number one. I'm actually now happy to accept a materially lower return if I have confidence that you're not going to lose my money and I can just generate a 5, 6, 7% yield on my income. I'm okay with that. And that probably has some relationship as well to the fact that the cost of capital across the globe has been lowered over the last 3-4 months owing to all the central banks reducing cash rates and interest rates and so on. On the other hand, there's an equally sizable segment of our client base that are saying, well, actually, I'm going to keep our powder dry because we believe, rightly or wrongly, that there's going to be some distress in the market come the December quarter into next year, when a lot of the government stimulus falls away and companies then have to start reporting, and people will realise that the real economy is actually significantly worse than they first think it is, and therefore there'll be a whole lot of opportunistic buys for us. And so we're going to go chase down those opportunities. And that's a pretty consistent theme, whether it's wholesale, family office, or institutional investors. They both seem to be polarizing in those two. And there seems to be a theme across the world, whether it's politics, investing, or whatever, polarization. Interestingly as well, probably in around May, we had probably 10 or 12 contacts from Hong Kong, Singapore, all reach out to us within the space of about a week or two, that we building relationships, some that we've transacted with, some that we haven't, all get in touch with us to find out where the opportunities were in Australia and where they could potentially deploy some capital, which one could speculate as a result of the news reaching the rest of the globe that Australia had done a relatively good job of getting things under control and things are getting back to normal, combined with perhaps some geopolitical changes happening in their part of the world. But certainly there's even a stronger desire, I believe, from Asian capital to consider Australia as a safe haven for investment.
Interesting. And that's what I was thinking when you mentioned about you get a lot of interest out of Hong Kong. I wouldn't be surprised if that continues to increase a lot over the next sort of 6 months or so.
Sure. I mean, but having said that, a lot of the wealth that we deal with in Hong Kong, like most places, already have their wealth not in Hong Kong. So it's not like it's a significant, they didn't see this coming and it was a big, they're standing there with a lot of the people that we deal with. It's ironic. We might have a Hong Kong national investing in via their Cayman BVI entity, via their Singapore-based private banker, and the trail for us our CTO, AML, know your customer, it's just a nightmare. But a lot of these people already have significant wealth outside of the country. But clearly that trend's going to continue.
So just for your strategy going forward, so you mentioned about the sort of retail sort of shopping centers, sort of for your last two transactions. What do you, so given that you do have obviously investors that are looking to be active, and I'm sure you're, knowing you personally, you're very proactive. What are you looking at the moment, and what types of deals are you looking to sort of, I suppose, secure or, invite investors into over the next sort of 3 to 6 months?
Well, look, our pipeline has, exploded over the last 3-4 months. So we track every single inquiry that comes into our office across the 3 offices, Brisbane, Sydney, and Melbourne. Anytime someone presents a financing opportunity to us, it gets logged in a platform where we can go back and track, by sector, location, who, what, when, where, all that type of thing. So we have a 3-year rolling average of what we expect the deal flow will be for a particular month. And we've well over double that for the last 3-4 months. It is extraordinary. And then that's a combination of the banks remaining fairly cautious about entertaining certainly new business, and a number of our peers who have decided to either cease lending altogether or significantly curb the lending that they had or were intending to do. So we've seen a lot more opportunity than ever before, which is fantastic because it means that we can be a lot more discerning. And that's not to say we're not discerning, because we've looked at about $7.5 billion worth of transactions, 400 transactions over the last 3 years, and we've probably executed on about 16 of those. And so when I look at our deal flow that's sitting on my desk here, it's a mix of residential, childcare, industrial, commercial office. It's fairly spread across many different sectors and across the 3 cities of Brisbane, Sydney, and Melbourne. So we're going to be focusing even more so on sponsor quality. Who are we partnering with? Who is the sponsor? What's their character? What have they done? Can they deliver? The underlying fundamentals of the real estate itself, be it commercial. I mean, there's a lot of white noise about the end of office as we know it, and will we need offices? And both you and I are doing this out of an office, so I think office will still have a place, albeit it'll change. Retail, neighbourhood retail, medical, childcare. Childcare is a key piece I think we've seen of this country, or any country's social infrastructure, insofar its ability to enable productivity to occur. I mean, you take away childcare, and arguably up to half of the population are unable to participate in the workforce.
That was actually one of my biggest lessons at the start of this, was the role that childcare plays in actually driving an economy and allowing things to function.
It's substantial, and whatever the cost is, the government will find a way to make it work, because it must make it work. So clearly that's a sector that we have a lot of faith in as well. So it's really just taking more time, Steve, to just look at the underlying tenant or the underlying driver for that real estate and understand why it's still going to be relevant in this post-COVID world.
Yeah. So my final question that I like to ask, right, and this might be a bit harder for you, but I typically love asking to it from a tech perspective, but I'm actually interested to get your thoughts on it. But thinking forward 5 to 10 years from now, how does it look from an investment perspective? What do you see as what the future of, whether it be commercial property, residential property, how does it change in the next 5 to 10 years from the trends that you already started to see over the last couple of years, and sort of conversations you're having, whether it be with developers or financiers or whoever it may be?
Yeah, well, where do you start? I mean, everyone's seen over the last, this pandemic has accelerated a lot of trends that were present and were starting to emerge, have been brought to the forefront across all sectors, across all aspects of life. And real estate is not immune to that, obviously. Clearly, the way we work, where we live, how we live, and those things are going to change, and they are already changing. I mean, I could go through so many examples, and we don't really have time here. I think from an investment perspective, I think hopefully, in 5 to 10 years, there'll be an increased level of transparency and exchange of information. Certainly in the private markets that we both work in, it can be difficult for investors to get to the bottom of what fair value is for something, because there's very limited information for comparable references and so on. So you know, the ability for investors to get access to more information to be able to make more informed decisions around investments. Hopefully more regulation, but not in a way that stifles business, is good. We've seen a number of people within the investment world that have come under scrutiny lately for less than complementary business practices and so on. And so I think, you know, consumers are going to demand more, and they're going to be smarter, and they're going to change the way that they act around and relate to investments and real estate and so on. So I know I'm not probably saying anything of substance here, because it's
well, I was going to say, if I was to pick two areas which I find interesting to think about in terms of property, is like, how does Internet of Things play a role? How does renewable energy play a role potentially? How does, you know, the ability to have, you know, so you saw the building, the way in which life's used for the, I just forgot their name, their new Atlassian building, or the other buildings that are actually setting up their own sort of gardens inside of it for production of food. And it's like, what are some of those other trends that could be sort of coming up that you're sort of hearing about or you think are interesting?
Well, I read something in I think it was in the Financial Review, or could have been one of the other publications, about the introduction of more, you know, concierge style services into offices, and offices changing from just being a place that someone comes to sit at a workstation and work to, you know, truly collaborate and live, and the types of services that building owners will need to provide, which will combine the Internet of Things, that will combine big data and the ability to aggregate that data to make conclusions about the types of tenants that they need to attract, and the types of tenants that will work with other types of tenants, to create more of a co-working, co-inhabiting space. I think almost, I mean, you think about what's happened with COVID and a lot of people deciding to work from home, and so companies are starting to think, well, maybe we need to rethink about the way we use our office space to be more collaborative and more meeting rooms, and get everyone in for once a week or once a month, and then everyone can work from home, and so it'll be less workstations, more entertaining event conference space. And what will that mean for hotels? Will there be will they merge together? Will you be able to bring a remote team from Sydney and Melbourne to come up to Brisbane for the weekend, have half of them stay, run some seminars, and then leave? I mean, you know, all these things are being talked about, and they're really
it's fun to think about. And I know from our side, we've got a model where we've got team members that will come in on on certain days. We've got others that are sort of rotating in and out. And we are looking to adapt that sort of collaboration model, because it makes sense, right? Because there's always ways to sort of create efficiency. So,
absolutely.
Well, Dan, much appreciated. If people want sort of more information on Newground Capital Partners, where are they best to go? Obviously, they can add yourself on LinkedIn, which is Daniel Ayres, and your website and so forth.
Yeah, they can access on the website. They can get in touch with us via email or phone. We are in Brisbane, Sydney, and Melbourne, so if people want and can entertain a face-to-face meeting, if that's allowed, then we'd be more happy to do so. But reach out via email or phone, and we can get on to our mailing list. We're pretty active in sending out updates and market thoughts and things like that, and get to know us, and hopefully something may be of interest, and end up becoming a client.
Well, thanks very much, Dan. Appreciate the time. So it's been great. Obviously, I said we've known each other for some time. So watching you grow, watching the business grow, both going overseas at the same time, both of us collaborating in Singapore.
How many times have we run into each other in Singapore? We're in the process of changing the office. Our new term's coming up, and we're moving boxes around. And I found one of the first wholesale investor magazines, and I just couldn't help but think, wow, how far has Steve come, wholesale investor? It's just that was only 10 years ago.
Crazy. It's gone now, but I actually we had some magazines on our boardroom table just as a reminder. It's always good to remember the roots.
You guys are doing a great job. Really excited to see how things are progressing, and I think this pandemic's been, in a way, kind of a great opportunity for you guys, and excited to see what the future holds.
Appreciate it. Thanks so much, Dan.
Thanks, Steve.
Yeah.
Bye.